we have done the various combination strategies and how an investor can use the combination of different option contracts while holding a stock to take advantage of the market fluctuations as well as hedge his or her position in the outstanding contract. Now we come to the topic of option pricing. By option pricing, I mean what should be the price of a call option and what should be the price of a put option. That is how much premium should be charged on the option contracts. Now, when we talk about option premium, it has two components as you can see on your screen. One is the intrinsic value of the option, and second is the time value. By intrinsic value, we mean to what extent the option is in the money or out of the money. A call option is in the money if the market price is higher than the exercise price. Okay, only then will you get some positive from exercising your call option. So when the security price is higher than the strike price, the call option is in the money, and for put option it is vice versa. When the market price is lower than the exercise price, then the put option is in the money. The second element in option premium is the time value. What is the time value of an option? Difference between option premium and intrinsic value. The time value is the time to expiration of the option. So longer time period to expiry will increase the value of the option, because जितना time होगा आपके पास option contract lapse होने से पहले, उतना ज़्यादा आप volatility से deal कर सकते हो in the security price. So time value of the option increases with the increase in time to expiry of the option. Okay, now these are the elements in option premium. Now let's have a look at what are the factors which affect option premium. First and foremost is change in the underlying security price. So you are dealing in stock options. If the price of the underlying stock increases, then your call option will have a higher value than the put option. अगर मार्केट प्राइस सिक्योरिटी का इंक्रीज हो रहा है, तो देयर इज अ चांस दैट इन द फ्यूचर with this subsequent increase in prices, you are more likely to exercise your call option than your put option. क्योंकि कॉल ऑप्शन इन द मनी तभी होती है जब सिक्योरिटी प्राइस हायर होता है एक्सरसाइज प्राइस से. ओके, और अगर ऑलरेडी मार्केट प्राइस इतना ज्यादा है तो आप पुट ऑप्शन एक्सरसाइज नहीं करोगे, आप डायरेक्टली अपनी सिक्योरिटी मार्केट में सेल कर दोगे. तो कॉल ऑप्शन का प्रीमियम ज्यादा होगा और पुट ऑप्शन का प्रीमियम कम होगा. सेकंड इज स्ट्राइक प्राइस. Same thing works. Strike price is the price at which you exercise the option. Okay. So अगर आपका strike price increase हो रहा है, okay, then what impact does it have on the call option or on the put option? If the strike price is increasing with respect to market price already, then you see whether the option will be in the money or out of the money. And the more the option is in the money, higher will be the premium on the option. तो अगर स्ट्राइक प्राइस इंक्रीज होता है तो कॉल ऑप्शन का प्रीमियम फॉल करता है और पुट ऑप्शन का प्रीमियम इंक्रीज करता है. ऐसा क्यों होगा? अगर आप जिस प्राइस पे शेयर खरीद सकते हो, अगर वही इंक्रीज हो रहा है अंडर द कॉल ऑप्शन, the exercise price is the price at which you actually implement the option contract. If that is increasing, then what benefit are you getting from a call option? You will have to purchase the share at an increased price, at an increased exercise price. So this has a negative impact on the call option. But for put option, this exercise price is the price at which you can sell the share. So if that is increasing, your put option is becoming more in the money and the premium on put option will also increase. Third factor is time to expiry, time value of option. So as I told you, the more is the time period to expiry, there is a more chance that your option contract will lapse in the money, and therefore both the option contracts, whether it is a call option, whether it is a put option, both will have an increased premium. 1 month ऑप्शन और अगर 3 मंथ ऑप्शन कॉन्ट्रैक्ट को कंपेयर करेंगे तो वो 3 मंथ वाला ऑप्शन कॉन्ट्रैक्ट की ज्यादा वैल्यू होगी, इसलिए उसका प्राइस भी ज्यादा होगा. Next is implied volatility. Volatility is fluctuation in prices. Okay. So if the underlying share which you have in your option contract, the price of that share fluctuates a lot in the market, then there are more chances that the option contract will lapse in the money. So for that, both put option and call option increase in value because of that, and hence their premium will also increase. Then the last factor is the interest rates. Interest rate in the market, if it is increasing, what impact does it have on the call option and on the put option? तो इसके लिए हम एग्जाम्पल देखते हैं. कॉल ऑप्शन का फायदा क्या होता है कि आप अभी सिर्फ प्रीमियम पे करके यू गेट द राइट टू परचेज द अंडरलाइंग सिक्योरिटी. ओके, सो देयर इज अ शेयर which is currently trading at 10 rupees and I want to buy 1000 shares of this company. If I have to buy 1000 shares, normally I will have to spend 1000 into 10 rupees, 10,000. Okay, but with the call option, if you buy the shares directly in the market, then you are spending rupees 10,000. Okay, or I go for a call option. Okay, because these shares are required by me after 1 month. So instead of blocking my money in shares for the entire month, I go for a 1 month call option and the premium on the option is rupee 1. Okay. Now this means for 1000 shares, by spending rupees 1000, I have the right to buy these shares after 1 month. Okay. At rupees 10 per share. 1000 शेयर्स हैं, आज आप उन 1000 शेयर्स के लिए सिर्फ 1000 स्पेंड कर रहे हो. आफ्टर 1 मंथ यू हैव द राइट टू बाय दोज शेयर्स एट रुपीज 10,000. नाउ व्हाट बेनिफिट डज द कॉल ऑप्शन सर्व? By blocking in 1000, you can buy these shares worth 10,000 after 1 month, which means extra money with you for 1 month is rupees 9,000. Okay, now if interest rate in the market is on the increase, your interest income from this 9,000 will also increase. This makes the call option valuable, more attractive, and hence the premium on call option will increase. Okay. On the other hand, if you are going for a put option, okay, so you are buying, you are going long on a put option in the increased interest rates in the market. What you will do now is that you will have to hold the shares for a longer period of time. मतलब अब 1 मंथ के लिए आपको, अगर आप ये शेयर सेल कर रहे हो तो ये 10,000 के शेयर्स आपको 1 मंथ के लिए अपने पास रखने पड़ेंगे, क्योंकि जो आपके इस ऑप्शन कॉन्ट्रैक्ट सॉरी जो पुट ऑप्शन कॉन्ट्रैक्ट का होल्डर है, यू आर गोइंग शॉर्ट ऑन द पुट ऑप्शन, सो यू दी सॉरी, I'll just correct myself. You're going long on the put option. The rates in the market are increasing. Okay. But you have entered into a contract to sell these shares. So you will have to hold these shares for a longer period of time to actually avail the benefit of put option. So you are sticking to these 10,000 worth of shares for 1 month. Okay. A better option would have been you could have sold shares of 10,000 today itself and invested this amount at the increased interest rate. Okay, now since you have a put option, you are going with this strategy, that is to hold these shares for 1 month, and you are losing out on the increased interest rates in the market. So this makes the put option less attractive, and hence premium on put option will decrease. Okay, then you have dividend. Now, all of us know by this time that when dividends are declared, it has a positive impact on the share price. But when dividends are distributed, it leads to a fall in the share price. तो जो ex dividend जो date होती है, ex dividend date is post the distribution of dividend. We experience a fall in the share prices because that is leading to a cash outflow from the business. So when the price of the share falls, the value of call option will fall and the value of put option will increase. So declaration and distribution of dividend, basically payment of dividends, will lead to a fall in the call option premium while an increase in the put option premium. So this is the summary of the points. Just read the points once again. If there's any concept, any factor which isn't clear, I'll explain it again. Yes, class, is this clear? The ones who are attending, please put a yes or no in the chat box. If there's any doubt, please ask. Okay, yes, Anjali, you can go ahead with the question.
Nothing, ma'am. It was just by mistake.
Sorry,
It's
what did
clear.
you say? It's clear? Okay.
Yes, ma'am.
Okay. Thank you everyone for your response. Now we move to the next concept, which is put call parity. Okay, so what is put call parity? Put call parity is a very important concept in option pricing. So it is a practical concept gaining more and more popularity because it helps us identify what should be the call premium if the put premium is given in the market and vice versa. So it is a concept which shows how the prices of put call and the underlying asset must be consistent with each other. Okay. A very important thing about put call parity relationship is that it works only with European options. European options are the options that can be exercised only on the expiry date, while American options can be exercised prior to expiry date also. Put call parity relationship works only with European option. Okay, so how is this parity working and what do we mean by this parity? For that, I'll take a simple example and let's try and understand the example. So, we take the scenario where the price of a share, price of a share is rupees, let's take it as 450, and the risk-free rate of interest in the market is 10%. Okay. Now there are two investment strategies that are available to an investor. One strategy is that the investor who is hopeful of the share prices increasing in the market goes long on the share. Long on the share means he buys this share for rupees 450, but at the same time he wants to safeguard himself from the possible decline in the value of the share. तो क्या करता है इन्वेस्टर, शेयर परचेज कर लिया और साथ में पुट ऑप्शन परचेज कर ली जिसका एक्सरसाइज प्राइस 450 है. इसका मतलब अगर आज से दिस इज अ 1 year option contract, we are taking a time frame of 1 year. So if this is a 1 year option contract, after 1 year, whatever be the market price in the stock market price of this share, the investor can sell this share at a minimum of rupees 450 by exercising the put option contract. So under this strategy, the investment made by the investor is 450 plus P. P stands for put option premium. Okay, this is the amount the investor is putting in this putting in this strategy at 0 point of time. Then there is another option with the buyer. What option does the buyer have? That instead of purchasing this share, which has a value of 450, the investor feels that okay, the price of this share can rise in the future. So instead of holding this share, I will go for a call option. And I go for a call option again with an exercise price of 450. Now for put call parity to work, the exercise price for call and put option should be the same, as well as the time to expiry should also be the same. So again, this call option contract has a time validity of 1 year. The second thing which the investor does under strategy 2 is that he invests his money in riskless asset. Okay? He's investing his money in a riskless bond. But how much amount is he investing? The amount should mature to rupees 450 in 1 year. इसका मतलब present value of 450 is the amount that is invested today. Okay. He wants a sum of money equal to the current exercise price in 1 year. Okay, so which means he is investing present value of 450 today because that will mature to rupees 450 in 1 year time. So this is coming to 409.09. इसका मतलब आज की डेट में 409.09 मनी इन्वेस्ट करेगा ताकि 1 year के बाद 450 मिल जाए. So what is the investment under this strategy? C stands for call option premium, and this is 409.09. This is what the investor is investing under strategy 2. Okay. Now, what we see is what is the impact of increase or decrease in price of the share at maturity of the contract. So, let us take two cases. Case 1, market price after 1 year increases to rupees 500. Okay. So, what happens under strategy 1 and strategy 2? स्ट्रैटेजी वन में आपके शेयर की वैल्यू 500 पे आपने शेयर 450 पे आपने शेयर खरीदा और आपको वो शेयर 500 में it is having the current market price of 500, so your shareholding is worth rupees 500 today. Your put option gives you an exercise price of 450 while the current market price is 500. Your put option expires worthless. So, what is your payoff from strategy 1? You are making a total of rupees 500. You can sell this share in the market at rupees 500 and pocket this money. Okay, this is case 1. We move to strategy 2. What happens under strategy 2? Your call option is giving you the choice of purchasing the share at 450 when the market price is 500. So, what is your benefit or intrinsic value of this option? कितना फायदा हो रहा है आपको कॉल ऑप्शन कॉन्ट्रैक्ट से? आपको 50 रुपीस का फायदा हो रहा है. ठीक है. When others in the market are purchasing this share at 500, you are purchasing this share at 450. Plus, you are having a riskless bond which has matured to rupees 450. So, your payoff under strategy 2 is also rupees 500. Okay, so you are indifferent between strategy 1 and strategy 2 when the price of the underlying security has increased in the market. We move to case 2 now, that is the just the opposite when the price of the underlying security falls. Okay, so we have a look at case 2. So let us take that the market price falls to 400 now. Now we'll see what is the payoff under both the strategies. अब शेयर की वैल्यू फॉल होके 400 हो गई. इसका मतलब जो वर्थ है आपके पास शेयर की, you were long on this share, that is 400 in the market. But what benefit you have is that you have a put option contract with an exercise price of 450. So while others are selling this share at 400 in the market, you can sell this share at 450. So the value of put option, the benefit from put option, उसकी intrinsic value आपके लिए है rupees 50. So your total payoff under strategy 1 is rupees 450. Under strategy 2, you have a call option and you have a riskless bond. अगर मार्केट में शेयर 400 का अवेलेबल है, आप 450 वाली कॉल ऑप्शन को एक्सरसाइज नहीं करोगे. You will let the call option lapse and hence the value of this option will be 0. आपके पास अभी भी अपना बॉन्ड है. आई एम राइटिंग RB, रिस्कलेस बॉन्ड, जो 450 आपको दे रहा है at the expiry of the investment in 1 year. So your payoff under strategy 2 again is equal to strategy 1, which is rupees 450. So what does put call parity say? Put call parity says that if you go long on a share and pay for a put option, then this left hand side of the equation should be equal to the call option premium plus the present value of exercise price. Okay. Using this equality, we can derive one value. If I have to derive the put option premium, then it will be C plus x1 plus RF raised to the power t minus SO. Okay. So call option premium plus present value of strike price minus the current market price of the share. I have three elements from this equation equality relationship. I can find out the fourth term accordingly. This holds true in the market. If there's any discrepancy, if at any point of time this equality is not holding, then there is an arbitrage opportunity. So people who have knowledge of the market, who deal in option contracts, they check this equality. If the equality is not holding, then for a short period of time there will be arbitrage opportunity. You buy the cheaper option, you invest in the cheaper strategy of the two, and you sell the uh, costlier choice of strategy under this. ओके तो अगर लेफ्ट हैंड साइड आपकी फॉर एग्जांपल से LHS is greater than RHS, so what you will do, you will invest in RHS of the equality relationship and then you will sell the left hand side. So there will be some arbitrage profit you will be making and vice versa. Buy the cheaper option, sell the costlier option, you will make some arbitrage profit. But again, like normal arbitrage contracts, this will not hold for long. Ultimately, the prices in the market will converge. Okay, and we reach back to the equality relationship. This is what put call parity says. So what we'll do is we'll take up cases जहाँ पर मिसमैच है दोनों लेंगे एक में LHS is greater than RHS and in the other RHS is greater than LHS, but that we'll take up in tomorrow's class.